Good morning, good afternoon, good noontime, wherever you might be, and welcome to the program. If you can hear me, if we can get a sound check, give a hello. Oh, there we go. Excellent, thanks, Ron. Hello, Phil. No, yeah, this is Roger. Good, that's Ron. And Amelia, boy, I'm probably butchering that name. This is Adam, Gary. Premnath, good. Ron, Asha, Rachel, good. Hey, this is loud and clear. Oh, good, good, good. Appreciate that insight. And a few more coming through. Outstanding. Well, good morning and welcome. Today we are presenting the Nadex Premium Strategy course. This is part 2, so welcome back. Hopefully you had a good experience in part 1. And we're here today for part 2. As I mentioned, my name is Roger. I am with Trade with Precision, and we are presenting today's program in conjunction with Nadex. So hopefully you are members or about to be members. Let me see if this will scroll down. Whoops, let me get, click there, push that. Oh, there we go. That's what we needed to see. So just as an introduction for today's program, this is an interactive webinar. If you have questions, and we have our first question up here. Someone had a problem with the video. Do you have it recorded? Yeah, Gary, you should have received a recording from last week's video. If you did not, let me know and we'll see what we can do about that. Okay, so moving on, today's webinar is interactive. So if you do have questions, please go ahead and type those into the question box and we'll take care of that. Also, I will stick around at the end of today's program so that if you have questions on what we've discussed today, then I'll be here to help you get clarification so that you understand the material before we go any further. Okay, today's risk warning, we have our disclaimers. We have a couple of them. I think you've seen them before. I've had this up here for a few seconds now. Let's see. Is it recording? Oh, there we go. Link to the first webinar up there. Okay. So this is our first disclaimer. This one is from Trade with Precision. And please take a moment to read through this. Just saying that today is for educational purposes only. We are not advisors of any kind and do not recommend any particular market. So having read through that, let us move on to our next one. This one is from Nadex. Very similar. Oh, we got a couple that did not receive last week's recording. Okay. We'll take note of that. Thank you. Pardon me. This is the disclaimer from Nadex, very similar in concept to the one from Trade with Precision. Yes, you can lose money. Do not trade with money you cannot afford to lose, etc. Okay, so having gotten through our legalese, and we're here for the next hour and a half, let us move on. So a little bit about the Nadex Premium Trading Strategy course. We're obviously going to start building on the foundations that we had from part 1. I always think that's a good place to continue. Want to pick up where we left off. It's a building process. Like anything else, like you go back and think about your math class, well, you first had to learn how to count before you could do arithmetic and subtraction and all those other good things. Same thing here. So we're picking up from part 1, and we had our technical analysis ingredients essentials for our 2 strategies. We're going to be continuing with those 2 strategies today, and we'll build on those essential analysis ingredients that you will have learned for for us to continue. Now, the strategies themselves, to make an analogy with the definition of a strategy, these are like the recipes. And this webinar today, we're going to take the ingredients within those recipes and put them into action with a concise, easy to understand set of rules. And it's following the rules that makes it so much easier, in that the rules are going to tell you what to do and when something happens. And following the rules allows you to take your emotions out of it. And that makes it a lot nicer as well. What's a big plus about this webinar and this program is that you are welcome to attend this as many times as you need to. And do not be afraid or do not be ashamed that you're coming back for multiple times, because everybody learns on a different pace. You may have been out there and been trying some things, and one moment here. Sorry, I didn't want to cough in your ear. Hopefully I didn't. I tried to mute myself when I did that. But don't be afraid of coming back again to get that. You'll pick up something that you may have missed the first time around. The analogy I make there is you're watching a movie for the second or third time, for example, and you realize, oh, I don't remember when he did that. Well, same concept follows on this one as well. So if you want to come back, please do. Okay, agenda. What are we going to do today? Well, we're going to get into the how and what of chart patterns. We'll look specifically at continuation and reversal patterns. I'll give you some explanations on that. I'm a personal fan of definitions, so we'll show you some things there that will help you understand things. I think if you have definitions of particular concepts, that it makes it a lot easier later on when you get into a scenario and say, well, I'm not sure what this is. If you fall back to a definition, you can see if what the scenario that you're looking at falls within that definition or not, and therefore allows you to make a better decision. We'll look at multiple time frame analysis. Now, I'm sure that most of you have looked at charts and what have you. Maybe you've only looked at daily charts or other such things. We're going to talk about multiple time frame analysis. So it's not just one time frame. We're not just looking at a daily chart as an example. Look at other things. And the purpose behind that is to improve your trading probabilities. There are no guarantees in life, and certainly none in trading. You'll have wins and losses, and hopefully more wins than losses. But when we make our trading decisions, we want to base that on the probabilities and putting the odds on our side. Reward versus risk. And that last word is a very key word. Too many times the amateur trader looks merely at what profit can I make on this particular trade, whereas the professional trader looks at how much am I putting at risk on this trade. So we're going to talk a little bit about that. The two trend following strategies. Now, we said we were going to have two strategies, and by golly, they are trend following. We are trend traders. And that means if you don't have a trend, you don't have a trade. So our two trend following strategies, one is the momentum breakout strategy. As the name suggests, we look for breakouts of price action. And the second one is trend flow strategy. And as that name suggests, we follow along with a particular trend looking to get involved with that. And something else that, one moment. Sorry about that. Something that I find helpful are practicals where we can look at charts and have you go through those with me and make sure that you're starting to understand the concepts that we're talking about. And if not, it helps to clear up any questions in your minds that you may have. before you're moving on. So here's an example of our momentum breakout strategy. Let me get my pen here. Let's see, I need a color. Let's see, what do we got up there? For the ladies, I'm going to go with pink. Okay, so now the momentum breakout strategy, what does that mean? Well, it means that we take a flat level, and I'm not very good with making straight lines with my mouse, so my apologies, but you get to understand the concept there. We have a flat level from this point across here, and we're looking for price action to break above that. So that's the momentum breakout strategy long and in concept. Before the day is out, you will see more details on this so that you more fully understand how this plays out. So that's just an introduction to that. Erase the drawings, go back to my cursor, there we go. Okay. So how about this one, mirror image? Momentum breakout strategy to the short side. Also, as a side note, for those of you who have experience in trading, you may be just familiar or more comfortable with going to the long side, and you're leaving out the opportunity to trade short. Markets go up as well as down. So if you're not comfortable or familiar with going short, meaning selling to the downside, I highly encourage you to get used to that concept, because you have the opportunity now to double your opportunities for trading. A little water here, because I don't know what's going on with my throat this morning. My apologies. See if that little tap of water helps out. If not, I'll have a mint here in a minute just in case, and see if that helps out. Okay, so here's a question. How many reasons can you list for going short? And just as a, not asking for any feedback yet, but here's the concept of looking at a short setup. And by the end of the session, you'll be able to answer that question with multiple reasons. We never want to take a trade merely on one reason. We're always looking for multiple reasons. So once again, we have a flat setup, support and resistance, in this case obviously support, and we are once again waiting for price action to break through that level of support so that we can take advantage of that to the downside. We look for moving averages. In this example, I'll call that purple is our 10-period moving average. The blue is a 20-period moving average, and the red is our 50-period moving average. So those are some definitions there as well. So anyway, that is an example of the strategy to the short side. How about the trend flow? Now this is the one that we said we want to look at for following a trend. Now, it's not so much, and I think it's pretty easy to see, okay, price action's moving higher, that's an uptrend. Okay, that's pretty front and simple. We learned about that. But we have a question here. What are the moving averages for in this strategy? And you mentioned, so Bobby, I think you're referring to the previous strategy, the momentum breakout, and that's an excellent question. Hang on to your hats on that one. Before the day is out, we will have an answer for you. If I do not get an answer when we get to that section, please come back and hit me on that one again. But we will go through that. So I appreciate the question. So the trend flow long, this would be the long setup, obviously. And what we're looking at is price action to pull back into what we call the buy zone, which would be that area between the 10-period and the 20-period moving average. So price action is pulling back, as we see here and we see here. So it's not so much that price action is moving higher, but for our entry points, we are looking for these pullbacks, because this is where we create the greatest amount of opportunity. And another question, exponential or simple moving average is the question. And the answer is, it doesn't matter. Personally, I use simple. Most platforms, when you pull up moving averages, will start you with simple. At the same time, if you are have found for yourself that the exponential moving average is better, then that's fine. The concepts still hold the same. There's no real difference from our purpose between the two. So hope that helps. Okay, we're also starting to look at different time frames. The shorter time frame here in the 120, which is the 2-hour chart, and the higher time frame at the 240, which would be obviously your 4-hour chart. So those looking at the introduction. How about a trend flow short? Once again, I emphasize that the opportunities are to the short side as well. Mirror image. Now we have our moving averages going to the downside. 10 period is below the 20, is below the 50. Same on both time frames. And again, we're looking for price action to pull back into this now sell zone. But it's still the concept of the area between the 10 and the 20 period moving average. If there's no space between there, then it doesn't give us any opportunity. So we're looking for our moving averages to be fanning out in the proper order. And once again, we're looking at a couple of time frames. And by the end of today, we'll have more details on that as to how to get in on those particular types of trades. So here's our promise to you that we will support and educate you on our easy to understand strategies applicable on any time frame and any market. So it doesn't matter whether you want to be a day trader looking at 5 and 15-minute charts, or if you're a swing trader looking at the hourly charts. It doesn't matter. And it doesn't matter what market it is. Whatever you're trading, this can work. Okay, chart patterns. We'll look at some common ones, see what we can show you on that. When we look at traditional trading, education is on the chart patterns. They're going to form the basis of strategy. This is the traditional approach. But instead of focusing on learning all the fancy names, because you can spend a lot of time looking at names, not only for chart patterns, but also for candle patterns themselves. And some of them are similar, but some of the candles have names. But what is important is that you understand what they're telling you, the story behind what you see, and the psychology behind a particular chart pattern. So this understanding is going to help serve you better, because now you'll be looking at things and you'll understand it, and to help yourself to trade in the direction of the major flow. That's the trend. So in general, we have two types of chart patterns, at least the ones that we are interested in. We have reversal patterns, and as the name suggests, this is showing patterns that are changing directions, going from an uptrend to a downtrend, downtrend to an uptrend. Or continuation patterns, where it's moving up, retraces, and then continues. So this is what we want to see and what we're looking for on particular charts, so that we can identify these strong trends and, more importantly, find suitable levels to join in on that trend and take advantage of that as a trader. So what are we talking about? Well, here's the first thing we're looking at, a reversal pattern. And these would be considered double tops or double bottoms, depending on which way you're looking. So on the left-hand side, we look at the double bottom. We have our downtrend. And remember our definition, we have lower lows, lower highs. So as of this junction right now, if we were looking at this chart in real time, this downtrend is still intact. It's not until come on, cursor, come back to me. There we go. It's not until we fail to break this lower low, thereby creating a higher low, hence our dotted lines here, and moving above our previous lower high, that we start to suspect that things are changing. So what we're looking at is simply this point, price point on the chart versus this one, and we see that they are lower, but there's two bottoms to it. It's not just a bounce and then going higher, like a V bottom, if you will. So we see that this is a double bottom, 1, 2, and then moving higher. Once price action breaks above this previous lower high, now the downtrend is no longer intact, and we start looking, is this merely a consolidation, or has a new trend, as shown here, started to take place? And we have a question. Does the wick count or just the body of the candle? Excellent, Richard. Yes, I would count either one. The wick does count. So yeah, good question. And on a double top, we have just a mirror image. So we have our uptrend, higher highs, higher lows. Our uptrend is intact through this higher low until we fail to break above the previous higher high. At this swing high, and that starts to turn down, we start to get suspicious and confirmed once price action breaks below this previous higher low. So moving down, we have now starting our new downtrend. This is a reversal, meaning a change of direction. We were going up, consolidate, we fall down. So now we have our uptrend to a downtrend. Again, if you can't remember double tops and double bottoms, not important. The concept is remembering the definition here. We're failing to break through, so our pattern, our definition of that downtrend is no longer intact and now is changing. Another reversal pattern is the head and shoulders. A little harder to see on the upside down, sometimes easier to see right side up, but here's the upside down pattern. And this is going from a downtrend to an uptrend, and very similar in concept to the double bottom, except for now we have 3 bottoms. So we have our downtrend, and once again, our downtrend is intact all the way through what's known as the head, which is the, as you would anticipate, the highest, or depending on which way you're going, lowest point in this example. So we have our head down here, but we don't know it's the head until we have our later setup. So, come on, Chris, there we go. So now we have our lower low, and remember, our downtrend as of this point is still intact. Not until, let me get my pen here. Not until we break this level above this previous lower high is our downtrend no longer intact. We have come up, we have a higher high, we come down to a higher low. So after this level holds and we start moving higher, now we can look at our pattern and see that we have a shoulder, our head, and our other shoulder. So think of a person hanging upside down, this is sort of what they would look like. And then we would look at this as the opportunity that we have 3 bottoms, it's head and shoulders, new trend, we were going down, now we're going up. So that's a reversal pattern for there. To erase that, back to my cursor. Okay, so continuation patterns. Well, we have ascending and descending triangles. Let me give you a quick example of what we're talking about here. So ascending, that's an ascending triangle. Now you have descending triangles. So your price action is coming in here, coming in there. That's where your price action is going. Your bull and bear flags, price action comes up like this and then sort of has a flag, the price action comes in there. Consolidations can be simply price action within support and resistance. And symmetrical triangles means there's no flat area, but it's just getting smaller and smaller in terms of range of price action. So again, the focus needs to be on why, and the main reason of what we're looking at with these types of patterns. And what we're looking at breakout, because where it's going to do, is it going to break out this way? Is it going to break out this way? Full flag here. Depending on the previous trend, if this was coming in here, maybe we're going down there. And then this way, are we going this way or this way? But the point is, it's breaking out of the pattern that we see on the chart. Erase that. And cursor. Okay. So the breakout. Well, using our analogy again, a little water here. So we want to take advantage of that force, the momentum that price action is having as it breaks out of those particular patterns. Doesn't matter whether it's resistance or support, but the point is it's going past that line in the sand, if you will. Now, think of volcanoes. They do the same thing. The hot magma underneath starts to build up, builds up pressure and pressure and pressure, and finally, the pressure gets to that point where it breaks through, and lava comes up, and the heat and the smoke and everything else goes through the air. It's a breakout. So that's the analogy here. Similar concept with price action. So what is a breakout? Well, generally, we look at a trade of a breakout is a well-defined flat level. Now, one of the earlier slides, we showed you a flat level and what we were anticipating would be happening. This flat level is defined as a minimum of 2 prior touches. Well, think back in geometry classes. 2 points make a line. Same concept here. We have 2 points at a horizontal price level. I typically call it 10. Price action hits 10, it pulls away, pulls back up into 10, pulls back again. Now we have a flat level. However, the more touches at a specific level, the stronger that support or resistance level becomes. So if you have just 2, that's the minimum. So now you can draw your straight line across and then start looking for price action to hit off of that again. And the more times it hits, the stronger that resistance becomes, or support. In the momentum breakout strategy, we harness this power of that support and resistance. So let's take a look at the Y's, if you can see on that. Okay, the Y's of breakouts. All right, here's our price action. We're moving along. We have a nice uptrend. We hit a price, okay, right here. We hit 1.5. Okay, and what happens? Well, buyers are pushing up, buyers are pushing up. Buyers run out of steam. There's no one left to buy, okay? Price action is going to fall back. The sellers take over. The buyers say, hey, this is a good price down here. I was willing to buy it over here. Now it's down here. That's a better price. I like that price. So they move up. Now we have our second hit and rejection of this price 1.5. Now that price is pulled back, we have 2 points. 2 points make a line. Start here, draw here, and then continue to the right is my recommendation, because then when price action comes back in, we more easily see that we may have rejection of this price level, which we do in our textbook example. So now, what we also see is during this time of forming this flat level, what is happening on the price action underneath? Well, when we first came up, we pulled back and we created a higher low, okay, because our other low was down here somewhere. We pulled in, we pulled back, but now we didn't pull back as far, so we obviously have another higher low. Pull up, we pull back, another higher low again. So what's happening, we're getting squeezed in our price. The pressure is building. We still have, even though we've got a flat level, we still have momentum to the upside. Until finally, the bulls say enough is enough, and everybody piles in. This is we're going long, and bing, bang, boom, we break through that 1.5. In terms of our trade, here's our breakout. We can buy and be prepared to buy just above our level of 1.5, maybe a pip or two above. And that proves that we're breaking through, and that gives you the chance to get in at a good price, because now we're just above this level. So we're not taking the risk down here in case it rolls over, but we've proved that we've broken through, that price action is willing to go higher. So we get in just above here and then off to the races. So some rules. As I said before, rules are always good because they're going to tell you what to do or not to do in a particular situation that you're looking on. Okay, we do not trade breakouts of sloping levels. We look for flat horizontal levels. Why? Well, yes, sloping levels, you will find examples where sloping levels have multiple hits on them, and price action does break on that. However, it's more subjective, and it's a weaker form of the support and resistance versus the horizontal. Remember, we're trying to put the odds on our side. So having done so, we look for horizontal, not sloping. And they don't give you that exact entry and stop location, as we just saw. We saw that flat level. We knew exactly where we were going to get in. Sloping levels do not act as the support and resistance, meaning when flat levels are broken, support becomes resistance, resistance becomes support. So those are our reasons why we look at horizontal levels. Now, the perfect breakout pattern, flat levels must have at least 2 touches to be true support and resistance to begin with. More the better, more the merrier, as the saying goes. Preferably 3 or more is even better. So we would look for that. Again, the stronger level has more. And when we get close to that levels, when we think that maybe this is going to break through at this time, we look for pricing to consolidate. Price action, we look for the size of the candles. We're looking for them to be smaller, not larger, but smaller, because that means that we're looking at somewhat of an equilibrium between buyers and sellers. Not one may have an advantage within that candle, but it's not overwhelming. Take a little mint here. Okay. So the breakout. Here we have a trend. In this case, we have a downtrend. That's pretty easy to see. We have our first rejection of this price point. Well, let's call it, for the sake of argument, let's call it 1.007. Okay, does that mean anything? No. When it pulls away, it's merely a swing low based on price action. So it doesn't pull away too far. It comes back down, drifts a little over, it comes back down, hits rejection again. Now we have something to do. We have 2 points at this horizontal line. And okay, you can argue that this one is touching and this one's just off a little bit. Close enough. We're not looking for precision here. We don't need to get the micrometer out. So 2 points make a line. We draw our line, extend it to the right, so that now with price action rejection, we see it pulled back. Someone had the question, do we include the tails? Here's your answer. We include the tails here and here. This was the body right there. So this shows that, yes, we do count both. But now we have 1, 2, 3. So we're stronger than just 2. We pull up, we pull back, we're holding, but look at the size of the candles. Not only are we being rejected on this particular candle, but notice it's smaller. So that's also what we're looking for. Price action breaks through on this very large candle. We would get in, once again, that 1 to 2 pips just below our horizontal level, which we, for our sake of argument, let's call it 1.007. So just below that 6 point something to get in on that. Okay, so that is the breakout that we're looking for to the downside. Classic example. Breakout convergence. Something else that we're going to be looking for when we are scanning our charts. Now, within the breakout strategy, a crucial keyword, crucial ingredient is that both indicators, we use 2 indicators that you'll see, both of these indicators must converge. Now, definition of converge. Convergence means that the indicator and price action are going in the same direction. Doesn't matter if it's up or down, but as long as they're going in the same way. At first, it might take you some time to look for what you're looking for. But what you're looking for, that convergence to be anticipating what the convergence will be when price breaks through, and that breakout. Meaning if price action were to break to the upside, we want to see that our indicators are looking at a minimum being flat to going up as well. So what are we looking at? Breakout convergence. Okay, get my cursor down here. Pretty easy to see. We have an uptrend and we have a flat level. 1, close enough. 2, minimum here. Now, so as a caveat, these 3 are right all together, hitting that same point without pulling away. I would consider that to be 1 hit, is my definition. But here, okay, so price is moving up. Let's look at our indicators. We use MACD, stands for Moving Average Convergence Divergence. And these are the levels. We use the out-of-the-box, so-called out-of-the-box or standard values for MACD. That's the 12, 26, and 9. So what are we looking for? Now, this is an uptrend, so we are concerned with higher highs because that's what an uptrend does. It makes higher highs. Yes, it's going to pull back, which is normal. We expect that. But as far as the indicator is concerned, we're not overly worried about that. Now, we also don't use these indicators in the traditional manner. So this is how we use them. We look for higher highs. Now, this is a flat level. We've been making higher highs, so our indicator is in the right direction. So we drop down. I guess I'll get my pen out for that. So we come down from here. Hey, not bad. You can't make a straight line. But anyway, so we have our baseline point, if you will, right here. Come over. We anticipate a potential breakout. We come down and look at where price is. Price is pretty flat, okay? You can argue it's sloping up a little bit there, but at a minimum, at least it's not going down. If it was doing this while trying to go up, it would not be convergent. Convergence is moving higher as it is doing here. So let's come down one more. Let's come down to our RSI, the Relative Strength Index. And once again, the value we use is the standard value of 14. And we see what our baseline value is here. And we come over and see what it is again. And we see it's flat. So once again, at least it's not diverging. We are having convergence. We anticipate this moving to the upside. We can see lower here, lower, higher here, and higher. Let's be after the fact. But this is what we anticipate is that our indicators are going to follow suit, so that price action and our indicators are going in the same direction. Definition of convergence. And erase that. And I need my cursor. Okay. So, looking at this chart, what do you guys think? We have price action. We have an uptrend. This is our previous trend into a flat level. This first hit doesn't mean much. Notice it cheated a little bit there. We come over it. We hit on same point. 2 points make a line. Add that to the right. Now we get our third point. So, should price action break to the upside, because this was our previous trend, higher, what do you think about our indicators, MACD and RSI? Are they going to be showing higher trends? Well, as we see here, here's our starting point. This creates our baseline, as shown by the red line here. This is not converging. They don't agree. Precisely right, Alicia. There's no agreement. Therefore, this is not convergence. Therefore, we would not be interested in this trade. Does it mean that price action is not going to break up? No, it might. But what we're anticipating is that it would not be as strong as if our indicators were going to the upside. That's why we're looking at that. Erase and cursor. Okay, multiple time frames. So we want to look at more time frames than just one, because we're looking for more confirmation. Just as we use the moving averages for confirmation of the trend, now we're looking at multiple time frames to confirm that what we see on the chart in terms of direction is exactly what we're looking at. Okay, so multiple time frames. This gives us a confirmation and improves our probability. Remember, we're trying to put the odds on our side. Anything that you do, you want to have in that direction, to be putting the odds on your side. Always advisable to check the higher time frame. Why? The trend of the higher time frame will indicate momentum that's been around for a longer period. And it's going to confirm that what you see on the chart is exactly what's happening, as opposed to looking at a lower time frame and saying, oh, this is an uptrend, I'm going to get in. When instead, if you look at a higher time frame and you say, oh, that's not an uptrend, that's merely a retracement of a downtrend. That's going to keep you out of bad trades. Major support and resistance areas will also be more apparent on the higher time frame because you have more calendar time involved in these higher time frames. If you have agreement from more than one time frame, it just gives you another reason to take a trade or a reason not to take a trade. Some of your best trades will be those that you don't even take. Okay, so what are we going to look at? Well, we'll look at some charts. If you're not familiar with these concepts, here's a chance to write some things down so that you're more familiar with them and can use them. What we look at are what we call a trigger chart, or our scanning chart, or our trading chart. We just call it a P chart. We trade with precision, so therefore it is a precision chart, a P chart. Anyway, it's your baseline, if you will. So if we're looking at a trade, this is where we would start. So for example, a flat level may be best defined within this time frame. The time frame higher or above our trigger chart is the confirmation. That's the P1. We're confirming what we see on our P chart, the trigger chart. And the question, what do I mean by higher time frame? Well, this is exactly it right here. So, excuse me. If you are a longer term trader and you use daily charts for your trading charts where you would take a trade on a daily chart, your confirmation chart will be the higher time frame, meaning a weekly chart. So on a daily chart, each of the candles represents price action within a particular day. Same thing on a weekly chart. Each candle represents the price action for a given week. So it doesn't take too much to understand that 5 days are contained within 1 week candle. So that's what I mean by a higher time frame. Now, if you want to trade on the lower time frames, for example, if you're using 4-hour charts, the 240 minutes, use a daily chart for your confirmation. The 1 hour, go to a 4-hour. And if you want to be day trading, short time frames, look at, and you're trading off of the 15-minute charts, that's your P chart, then you can use the 1-hour chart as your confirmation. Okay, give you a second in case you're still writing that down. And even if you're using the shorter time frame, it never hurts to take a peek at the daily just to see what's going on the longer time frames. Okay. So trends. Here's what we're talking about. So our shorter time frame on the right, this is obviously the same market. This is euro dollar. We look at the 240 minute and we see that, well, we have a downtrend. Eyeballs can easily see that moving. We go back to our definition and we see that we have lower highs, lower lows. Our definition is complete. Okay, that is a downtrend. Now we want to confirm that what we see is indeed what's going on. So we go to a higher time frame, what we saw on the previous slide. We go to the daily chart. What's going on with the daily chart? Well, first thing we see bigger candles. Well, why do we see bigger candles? Because there's more time involved in a daily chart compared to the 240. But go to our definition. Do we have a downtrend? Well, we can see the price is lower, and we go to our definition, and yes, indeed, we have lower highs and lower lows. Therefore, we have a downtrend. Downtrend on the lower time frame, confirmed on the higher time frame. Both time frames are downtrending. Having this, now that's our baseline. That's our first thing we're going to look for on our checklist to see if we have confirmation of the trend before we can determine whether we even want to take a trade or not. If you don't have confirmation, no need to go any further. Pretty easy. So is the trend certain on this one? Here we have our downtrend. Again, this is the CAD versus Swiss. And over here on the 240, well, looks like an uptrend. Moving averages have all gone the right way. Well, we get higher highs, higher low. Okay, we got an uptrend. All right, let's get confirmation. We're on a 240. Let's go to a daily chart. Daily chart. Boom, 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 boom. Well, that's a downtrend. We have not passed this previous lower high. Therefore, our downtrend is still intact. What we saw on the lower time frame was not confirmed on the higher time frame. So if we use the 240 minute as our trading chart and we had confirmation that it was not what we wanted, no trend, no trade, don't need to go any further. Okay? I think that's a pretty easy concept to get. How about this one? Now go to a little shorter time frame. Concept still the same. We have the euro pound. Shorter on the right, 60 minutes. What do we have? Well, we've got our trend. Let's see, uptrend, definition, higher highs, higher lows. Okay, that's an uptrend. Everything looks right. Trend is up. Let's get confirmation. From now, we go from a 60-minute So the 1 hour, we go from the 1 hour to the 4 hour. Then we look over there. Oh, eyeballs tell us that the trend is going up. Look at the definition. Yep, this is good. Moving averages in the right order. We have an uptrend. Confirmation that what we see is what we want. So we have an uptrend. Now we go to the next step on their checklist. We'll get into that in a minute, but just to confirm that this is how we use this for our confirmation on that. Okay. Reward versus risk. Now, I said before that the amateurs look at charts and say, wow, I can get in at 10 and go to 12. That is great. Now, they're not looking at the risk. The professional trader will look at this, okay, if I'm getting in at 10, I'm willing to risk 1 on this, so I'm going to, if something goes against me, I'm getting out at 9. That's my risk. All right, now I know my risk. Now, what do I want to look for as a potential reward? So if you think of risk first, you'll be ahead of the game. Can you get away from risk? The only way to do it is not to trade. And that's not why we're here, is it? So every time you enter a trade, you have the risk of losing capital, meaning you could have a losing trade. Are you going to have losing trades? Absolutely. That's the only guarantee I can give you. Hopefully there aren't as many as your winners. That's our goal, obviously. But the point is that when you place a trade, we have to accept that there is the potential for a loss. Therefore, we have to make that loss acceptable to us, should it happen. Now, obviously, there's the payoff in that while we put money at risk, we obviously want our trade to go in our direction so that our potential is more than what we were risking. Now, as traders, it becomes beholden on ourselves because trading, one of my expressions, is all about you. Some of you will be willing to risk $100 on a trade. Some of you will say, that's too much, I'm only going to risk 50. Others will say, I'm going to risk 500. It's all different. You have to do what's right for each individual. So that is what becomes our responsibility by looking at risk to help ensure that the sum of the winning trades is greater than the sum of the losing trades. We can do that, we'll be able to stick around for a while. So what about stop losses? Well, when you trade with the spreads or a binary option, the benefit of using the Nadex contracts is that your stop loss is, in essence, already built in. That's kind of nice. It gives you one less thing you have to worry about. Now, the ideal scenario with the Nadex is to be able to define your risk prior to entering your trade. So you're not creating a stop loss per se, but you are still looking at the risk, which also goes into your stop loss. So you're still defining what am I willing to risk on this particular trade. Now, most situations with Nadex, you don't use the traditional stop loss when you're trading the binaries and spreads, but we still need to look at risk management because it doesn't matter what you're trading. You need to trade and understand what your maximum loss could potentially be. Okay, here's an example. Looking at binary options. Okay, so on the left, get my ticket down here. So we're going to buy. Okay, that's highlighted, so that's what we're doing. If you don't want to, you just click on sell and you can go back and forth, doesn't matter. The concept is the same. So we're going to buy. Order type, well, this is a limit order, and our size is what we determine our risk. This is our price is at 50. Well, our floor, let me get my pen down here. Okay, so we have our size, very important, price. Price is 50. We know that our floor goes from 0 to 100. That's it. Can't go higher, can't go lower. So at a price of 50, we're smack dab in the middle. So if our price is 50, that's what we're paying. Now, with the binary options, you can't lose more than what you pay for that contract. So we paid 50, we're risking 50. That's your max loss. Subtract the max loss from the maximum, 50 from 50, gives you your max profit of 50. So now we have a 1-to-1 reward to risk ratio. Okay. But let's say, for example, that you're in the market where 50 is too small. You want to trade $300. That's your maximum risk. Didn't mean to cross that out. So what's the simple thing to do? You change your size of your position. Instead of only trading one contract, now you're going to trade 6. 6 times 50 gives us our 300. So it's simply determining your predefined risk and the current price and simple math, number of contracts to be close to that. Okay. I think that's pretty straight. And erase that and click. Okay. What about on a spread? Well, similar concept. We're going to buy again. We have our price on here. We know right now, just as we saw before, what is our max loss? Our max loss, what we're paying, is 40. We can't lose more than $40 on this particular trade. We see our floor and our ceiling. So if it goes below the floor, we lose this. If it goes above the ceiling, we max out on our profit. What's our profit? 360. That's a pretty good reward to risk ratio. What if we're willing to risk more than 40? Well, here's one here. If now we're trading, I'm sorry, the clarification here. If you're buying a spread near the floor, you have the opportunity for a greater opportunity for the reward, or selling near the ceiling. Now, if you're in the middle of the contract, now you're looking at more of that 1-to-1, risking 200 to make 200. So it just depends on what style of order it is that you want to be as to where you, as an individual, are making your decisions. Putting it in for your limit order, says I want to get at this price or better. That helps to limit your losses as well, because if it goes the wrong way, your order, after you place it, your order is not placed because it does not meet your requirements. So that's another way to look at it. Okay. A reasonable place for a stop. Now, in the momentum breakout strategy, if we were looking strictly on a chart to determine how to play things, we have our uptrend as we saw before. This is the same chart that we had in our textbook example. The first hit means nothing. We pull back. Our trend is still intact. We have a higher low. We pull in. Now, on this rejection, I count these as 1. We now have our 2 points make a line. Extend that to the right. We see what happens from here. We start to get interested in this overhead resistance. More so as we get closer, we get smaller candles. Okay, now we're still not breaking above, but what we expect is that this price action is going to go higher. And when it breaks, that's what this dotted line is, this is where we're getting in. Remember that 1 to 2 pips above this horizontal flat line. But what happens if we get in on this trade and, oh, let's say news comes out that goes against us? Come on, cursor, where are you? There we go. So we're starting off, we're doing well, we're making money, but news comes out and says, no, we don't like that. Price action rolls over and now starts heading lower. Well, at what point are you going to cry uncle? What we're suggesting is one opportunity for a stop loss would be below this higher low. Now, why do we say that? And again, this dotted line represents that stop loss. And again, it's a pip or two below this low of the candle, below that wick. Anything below, when price action goes below this level, we have a lower low. If we have a lower low, we no longer have an uptrend. That's our definition. So if that's going lower, if this is a lower low, potentially price action, this could have been a reversal and price action is changing. So if we were long, we certainly don't want to be in a down market if we're long. So we're going to cut our losses at this point right here. And we will determine whatever this value is times the number of contracts, that is what we are willing to risk. That $50, $100, $300, whatever it is equal to here. So that is where we can put our stop loss to give us some wiggle room, because if price actually comes down and then comes back up again, we're okay. So is that the only place to do it? Well, depending on your style of trading, you could have a more aggressive stop and put that below. This is the same chart again, so nothing's changed. This is the first one we showed you, was right here in the middle. Your momentum, if you put it here, you're doing two things. Minimizing the number of pips between entry and stop loss, which gives you the opportunity to have more contracts based on times your, or to equal your stop loss to get to the $50 or $100 versus here, right? Or, and again, more experienced traders may be using that. Give yourself more room, more wiggle room to come back down here behind the second stop, which allows price action to come way down here before going higher, but it still keeps you in the trade. That's the idea of the stop loss, is that once you're in, it gives you some wiggle room to allow price action to pull back before heading in your direction, but not so far as to break the bank, so to speak. So some ideas of where to place stop loss and the rest, some of the rationale behind that. So the best place, how about new strategy now? Let's talk about the trend flow strategy, but still under the concept of a stop loss. In this example, this happens to be the long trade. We have an uptrend, nice uptrend, pull back, uptrend, pull back. We're in the zone. We have our bullish candle between the 10 and 20. This is where we would be looking for price action to continue in the direction of our trend. This example, we're going higher. So with that, this is our trigger candle. Once it closes, and not before, then we set our entry just above the high of that candle, 1-2 pips. That's where we're going to get in. But what happens if we get in and our proverbial news comes out that goes against us? Then price action is going to roll over, come back down here, and if price goes below this, this retracement has not complete. The trend is continuing lower we're going to cry uncle and say, this is where I want out. This is where I have predefined my $50 stop loss or $100, whatever it happens to be. I'm sorry, stop means when to stop trading. A stop loss, not stop trading per se, but where we would get out. So let's say, for example, easy numbers. This is 10, okay? So we enter this, we're in this market, the price action breaks above 10. It goes to 10.1. Okay, we're going to buy this market because we anticipate this going long. So we enter. We're in this contract at 10.1. Price action starts to go up. Great, we're happy. We're starting to make money. It's up to 10.5, whatever it is. Again, I'm just making numbers. News comes out that says, no, this market is going lower. Price action rolls over and comes back down. It hits below this price. This is where we said that if price comes down here, that's the most that we want to lose. Therefore, we're going to sell our position at this point, getting out at our predefined stop loss. So we're only getting out of this particular trade as opposed to stop trading in and of itself. Okay, hope that clarifies. All questions are good. So again, if price actually comes down below here, this retracement, one of two things, is not complete, or price action is rolling over and we could be headed for a downtrend. Okay, now we said we were going to get into our two strategies. First one that we'll talk about is our momentum breakout strategies, and we'll start giving you the details on that. We're going to start giving you the recipe of how this is going to play out. Okay. Trading breakouts of flat horizontal levels. We've shown you some examples. We want to trade in the direction of the trend. Okay, so if we're at a previous uptrend before we hit that flat level, we expect this to continue to the upside. We look for convergence on the break of that flat level with price and both of our indicators, MACD and RSI. Again, you're coming straight down from those price points, seeing what your indicators are doing. Placing our stops with strong price action support to protect them. That would be your support and resistance levels, your swing lows, swing highs, those types of things where price action has shown to reverse. And risk. Always, always look at risk in your trades. We suggest a maximum of 1% of your capital on any given trade. Okay, a maximum. Does that mean that you have to do 1%? No. If you're getting into a scenario that you think, well, everything looks good, I just don't have a good feeling about it, you don't have to put 1%. You can go 0.5% or whatever other portion. You can put less in. That way, if it goes against you, you're not losing as much. But if it goes your direction, well, then you made something on it. Bonus factors, okay? Not required. The previous was required. Bonus. This gives you, this is more probabilities. We're getting the odds on your side. Additional ingredients. Moving averages. At the breakout, it's nice if price is in or around those moving average buy and sell zones. If the correct moving average geometry in the uptrend, the 10 is above the 20 is above the 50, with a little bit of space between them. The candlesticks. We want to see the price action consolidating just before the breakout level. And those candles, we use the word bars, same concept, should be small just before the breakout. Now, those are just bonus factors. That helps. Okay? Give you a second if you're writing that down. So moving averages and candlesticks are going to help. We always want to look for them. How about more bonus factors? Indicators. Ensure that our indicators will not diverge. Now, not diverging means just flat. Flat is okay because they're not going the opposite direction if it's flat. Multiple time frames. We're looking for higher time frames to see what's going on there to improve our probability of success. And going to higher time frames is also going to show that you're not going against the trend on that higher time frame. Remember, we showed you that one lower time frame looked like an uptrend. We go to the higher time frame and it's still within the downtrend. We want to avoid that. Two more bonus factors for our momentum breakout strategy. Okay. All right, here's a chance for interaction. I'm going to check your typing skills. Here's the practical. How many reasons can you list for a short trade? Okay, hopefully you've got your list. Take a look. See what you think. Type this in the question box, and we'll go through those and see what's what. So go ahead. Let's do that. I'm going to. Okay. You probably don't want my singing. So I'll just wait here for a minute. What you guys think? Do some looking at that. Oh, there we go. Now we get some answers. Good, good, good. Participation is always fun. Makes it so much better. Very good. Coming in for a second shot. That's all right. Good, good. This is going to help you, folks. You're starting to. This is where you're starting to train your mind and your eyes to start looking for these concepts. And I highly recommend that you do go out and back test these things and look for them. Come in for a couple times there. Okay, that's all right. All right, we'll give you 10 more seconds. Not sure what that means. Somebody wrote, looks like the number 4. I'm not sure what you mean by that. Okay, 5 seconds. Start moving. Okay. All right, here we go. Let's read through some of these. Let's see, where am I? Below the 50 RSI, down MACD is down. Okay, yeah. We don't worry about the levels on RSI. We look for just the trend of the actuality. So we're a little different than the traditional manner. So even though the chart shows you the lines on the 70s and 30s and 50s, don't worry about the values. Indicators suggest a downtrend. Enter on the break of support. Very good. Let's see, convergence, moving averages, smaller candles, good. Consolidating, good. Indicators, MACD and RSI, minimally supportive. Consolidation and convergence of the two indicators, good. Small candles, yeah. Actually, Richard, you said diverging? No, I wouldn't say diverging. Let's let's see what this says. There is convergence. Yes, we need to check higher time frame. Very good. Trend looks like it is going down for a short trade. MACD and RSI confirms convergence. Outstanding. Well done. Yes. So we have, here's our trend right here. So we have that downtrend, and we're looking for lower lows, lower highs. We've got that. We've got our flat level in here. That's good. Now, let's see what else. We got consolidation of prices coming in here. Our moving averages are in the proper alignment. Price action is in the zone. All that is good. Now, one thing that was not mentioned was risk, stop loss. Where would you put your stop loss? Now, maybe back here, give us a little more wiggle room. Excuse me, one moment. Sorry. So this might be an area that you might consider for a stop loss, putting it back here. Price action breaks through. We've got our support and resistance line here, so that's going to help. Support, price comes back through. Let me get my pen here. So here's our flat level. Price action breaks through. We get in. Here's our stop loss. So now, if price action comes back, extend that to the right. If price action comes back up, there's a good chance that it's going to be rejected at our support and resistance level, wherever it may be. Again, I'm not very good with my cursor here. You get the concept, before going down further. Okay, so there's a good chance of that. So something else to consider there as well. All right, you guys did pretty well. You guys were hitting a lot of the concepts. That's great. Good job. Okay, and next slide. Okay. Here's a practical, and in your own words, because that means more to someone rather than somebody else's words. But the concept as the decisive ingredients required for the momentum breakout strategy. So what I would suggest, because we don't have time for everything, but write down the 6 points that you see here: support and resistance, trends, moving averages, candles, small versus big, indicators, convergence, divergence, reward versus risk. Write down those 6 points, and then when we finish today, after the fact, you can write in a more expansive concept of what you would be looking for in these ingredients, and have that in your own words so that you have an understanding of what the definition would be for support and resistance. What are we talking about when we mean trends? What do we want for moving averages? What is precision? What is a bonus? The candles. What's the definition of a small candle? Well, it's less than half of a big candle. Our convergence, divergence. How does that compare to price action? Okay, so write those down in your own make your own definitions so that you know what's what. Okay, what about the trend flow strategy? We showed you the momentum breakout. Now, here's our recipe. These are the details that we're looking for on this. 1 second. Okay, so now we really want to be looking at those time frames, because now we're following the trend, and we want to make sure that the trend that we see is the trend that is actually going on. So the trend must be present on a minimum of 2 time frames. That's our P chart, our P1 chart. That's a minimum. If you want to go to P2, that's okay as well. Nothing wrong with that. The moving averages must be fanning out. They must have the proper geometry. Space between them. Similar angles. They're all going up in approximately the same direction. Your entry into a trade would be defined by that bullish candle in the buy zone once you've had a pullback. So we're looking to get in after the retracement. That's for the long setup, obviously. We're buying after price breaks through the high of that bullish candle in the zone. Mirror image. In the sell zone, we're looking after retracement. We're looking for that bearish candle. And we're going to sell as price breaks below the low of that candle. Again, we're talking about 1-2 pips. Place your stop loss with strong price support protecting it. You're looking for those swing highs, swing lows, depending on the scenario. Always look at risk. Your maximum of 1%, no more. Again, doesn't have to be that high. If something doesn't look out right, look a little lower. No, thanks, Gary. Okay, so that is our recipe. That's what we have to have. That's the minimum. If you don't have this, no trade. What about bonus factors? Once again, this is going to help us improve our odds. Not required, but nice to have. Indicator convergence on all time frames. Improving the odds of success. Candlesticks. The best trades, the candles should be small as price pulls back into that zone. We want them to be smaller in there. We're looking for that. Okay, those are 2 bonus factors. How about a couple more? Price action, support and resistance levels. Bouncing and rejecting off these levels. This includes big numbers. That is, numbers with at least 2 zeros or 3 zeros in the price. That's considered a big number. If you have price action and if you have support and got a tongue twister here. If you have these big numbers and support and resistance levels at the same price, that's a bonus. Now, if you have that level between your entry and your stop loss, that is protecting your stop loss. That's what we're talking about. It's in between there. And multiple time frames, you're not limited to one, so you can go from P1 to P2, maybe even P3. And let's see, we have a question. In the trend flow approach, you are assuming that spread contracts will be used since there are no stop losses that can be inserted on the standard Nadex. Yeah, fair question, Wilbur. If you're using the spreads, now we're trying to give you generic concepts here, so that if you're using it on a different type of chart. But yes, if you're not using stop losses and you're using strictly the amount that you're paying for your contract as your stop loss, that's fine. That's good. The point is that you have a stop loss. Now, we've got a couple here. A couple people are mentioning mental stop losses. Well, yeah, you can use a mental stop loss. The challenge is that you may not be quick enough, if it's a fast-moving market, to get out at your mental stop. So if you enter your stop ahead of time, whether it be if you're risking, let's say, for example, you're risking the debit paid on a contract, well, that's okay. That becomes your stop loss. And you're automatically out. But if you're getting in on one of the previous examples, we were getting in midstream, so it was a 1-to-1. In that scenario, if something comes out and it starts moving price against you, well, nothing says you have to wait for your stop loss to trigger. You can get out ahead of time. That's okay too. So you're selling. Yes, you can sell at the market if you, as opposed to a limit order. That's a good point, Richard. Selling at the market will get you out faster, without question. Yep, that's a good point. Wilbert, if I didn't answer your question, come back and hit me again. I think I did, but we'll go from there. Okay. Let's see. I think we're on to the next slide. So here's a trend flow. Pardon me. Looking at this smaller time frame, higher time frame. Now I won't have to get in close in time here. So mentally, I'll give you a few seconds. Now, how many reasons can you list for a short trade? What do you see on this one? Go through and see what you think. Look on this. What do you see for the short trade? Okay, so what do we have? Here's our trading chart. This is our P chart. This would be P1. We have a downtrend. Moving averages are in the right order. We have a pullback into the zone. Nice small candle. Now, when we look at our indicators, because we're looking at a downtrend, we're looking at the lows only. Okay? So here's a low, we come straight down. Here's our baseline. Here's our new low, we come down. This low is lower than this low. This is convergence. What about MACD? Well, that's lower here. So we made a lower low. This is convergent. Let's go to our confirmation chart. Do we have a downtrend? Well, lower lows, lower highs. Yeah, moving averages are good. Price has pulled back into the zone. Good enough. Pretty easy to see that we have a downtrend here on RSI. Straight line practically on MACD. Convergence all around. Looking pretty good on the short trade on that. Let's see, comment. Low, yes, you're correct, Joe. Lower time frame agrees with the higher time frame. This would be an opportunity to find the going short below this candle right here. This is our trigger candle. So once that closes, price action goes below, we're in. Once again, in your own words, for this strategy, this being the trend flow strategy, same concepts, support and resistance, the trends, moving averages, candles, indicator convergence, divergence, reward versus risk. You should have this list from the previous one, but now you want a second checklist for this specific trading strategy, and you can do that after the fact. Okay. Some trade examples. Here we go. We'll have some other time frames, but to start out, this would be our P chart. So what are we looking at? Well, we have an uptrend. Okay, we have a big pullback here, but we've continued our uptrend. Moving averages are in the right order. Oh, wait a minute now. I see a flat level. Oh, okay. So we see a flat level. We start thinking momentum breakout strategy. What are the indicators doing? Well, it looks like it's going up. It looks like it's going up. It didn't reach the same high as previously, but within this range, from here to here, this is our baseline because this would be the newest high. You come down here, I call that an uptrend. Yeah, this one, not quite, but at least it's flat. It's not going down. So you can argue that one either way. That comes under the art of trading. Let's look at another higher time frames. We go to the 240 after the hourly, and then the daily. So we've got a flat level here. Moving averages are good. We're close. We've got small candles, and that looks pretty flat. I'll call that flat. Yeah, it's down from here. So you can argue how that we do have, well, yeah, all right. So I guess that is a little higher there than here. So we do have some divergence. Certainly have divergence here. That is lower than, so looking at these 2 points, that is lower. And what about on the daily? We have a good time, we have a good movement. Now this shows how with the higher time frames, you don't get to see the flat level. So we're looking to confirm that we have an uptrend. And well, we've got a little bit of divergence here too, don't we? Certainly, because now we're looking at this point to this point. This is higher than over here, as this is. So we do have some divergence going on within this. A lot of good things, a lot of bad things. How do you try to make that decision? Well, the tough part is it comes under the art of trading. We can tell you that that first chart looked pretty good. We had other things going on. Some of the things in here look good. You know, with this part is lower, so we have some divergence here, but it was trending up. That's hard to say. There's some things going both ways. Depending on your experience, would depend on how that would work out. How about trade number 2? Is there a trade set up here? Okay, now we're into the short time frames. Oh, we're over here with the 1 minute. For you day traders, what do we have? Well, moving averages have crossed. So, but we're still above this lower high, or lower low, excuse me, lower low over here. Higher low, pardon me, higher low, excuse me. This is a higher low compared to here. So that's a higher low. This is a higher low again. So the uptrend is still intact, but the moving averages have crossed. We have divergence on the indicators. So what do we do on the 2 minute chart? Well, this looks better on price action, where moving averages look pretty good. Price action's right in the zone. And I would call that convergence. We have a higher high here and here. That looks pretty good on there. So the 1 minute looks terrible. 5 minute looks pretty good. This looks better. There's a strong trend there. That goes up. Small in the zone. So I would not take the trade on the 1 minute chart, but maybe the 2 minute chart offers a better opportunity. So we can look at it that way as well. It's another way to look at it. Again, how do you determine that pullback? Is that too far? Well, that's a pretty big pullback compared to some of these other ones, but it has started to turn. Some things to consider. Trade number 3. Here's a short setup. Here's our 60 minute. This would be our P chart here. P1 on this side. Well, let's see what we have. We have the downtrend. Moving averages are good. We're in the zone. Somewhat of a smaller candle. There's some bigger candles here. We're below average. It's not super small, but it's not super big. And we've got lower lows on our indicator for MACD. And it's pretty flat there, but at least it's not diverging, so that part's okay. Moving averages are good. Downtrend, price action is in the zone. Indecision candle there, bearish. Indicators very convergent, very convergent. Okay, we've got potential. Should price action break below there, we might be in. Stop loss above here. So there's the potential. Okay, so homework. Yeah, right back in school again. Here's some things to look at. create a watch list of underlying contracts. Here's the charting package for a list, and start identifying the strategies on these live markets. This is going to help start to train your mind and your eyes on what to look for. Get to familiarize yourself with all of the technical aspects of these two strategies that we showed. Start to get comfortable with the strategies. Going through your checklist that you have, the ones in your words, so that you understand what you have written down compares to what you see on the chart. You want to find at least one example of each. That's going long and going short. So that's at least 4 charts that you want to hit. Consider which Nadex contracts you might trade by identifying your risk based on price action. Okay, so do some kind of paper trading. Find some trades. How would you do it? What would you trade? What would you have for your stop loss? How much are you willing to risk on that? And keep your records. You can do a screen print in PowerPoint. PowerPoint's great because you can just keep adding more and more, and then you can put your notes in there. Why did I get into this trade? What did I see? What did I like? What did I didn't like? And you can come back and use this as your education to see what you, after the fact, after your trade worked out or didn't work out, go back in, take another screenshot, put your notes in. Why did I get out? Why did I go all the way? Whatever it is. So now for part 3 coming up next week. If you haven't, please sign up for that. Hopefully you are enjoying part 2. We're going to apply what we've learned to trade Nadex contracts. We'll obviously have some real-time examples. Contract selection based on the trade setup. And as we said, if you haven't already registered, I think you know where to do that. That is going to end today's presentation. As I said, I will stick around for a minute. If you have questions, please go ahead. You're welcome, Richard. Yes, Bobby. Moving averages, we use the 10, 20, and 50. Yeah. You can throw that, if you're a long-term trader, you can throw the 200 in there, but generally the 10, 20, 50 is what we use. Yeah. You are very welcome. Thank you for coming out today. Sounds like some of you got some good points in there. That's great. Oh, here's a great question. Hey, you're really thinking here, Terrell. The question is, can the momentum and trend flow strategies be used together? There can be times that, yes, they will hit. It may or may not be, well, it could be on the break. Yeah, it could be. Or another scenario that might happen is that you've identified a momentum breakout strategy, and price action breaks through that flat level and then pulls back. And that pullback might be into the buy zone. So I'm talking about a long trade here. It might pull back into the buy zone. So now you're already in on a momentum breakout strategy position, but then the opportunity comes up with the trend flow long trade. So yeah, it's possible. I'm not saying it's common, but it's possible. Yes, absolutely. Another question, is it possible to get a transcript? I don't know about the transcript, but the recording is supposed to be sent out to everybody here today. No, the part 1 would be associated with Nadex, because this is being presented through Nadex, not Trade with Precision. I'm from Trade with Precision, but we do the training in conjunction with Nadex. So yeah, anything would come from them on that. They have that available. You're welcome, Terrell. Let's see, that will do. I think you're getting that recording. I think that should come out within a day. So sometime tomorrow, I think that's when that comes out. overnight or tomorrow, somewhere in that time frame. Generally within 24 hours. Yep. And yes, Angela, you may ask. You are welcome. Yeah. Okay. Any other questions? Type them in the box.